I'm convinced that Wall Street still doesn't understand Nvidia. Nvidia stock is down by over 10% after one of their best earnings calls ever, and I think I figured out why. So in this video, I'll break down everything you need to know about Nvidia's latest earnings, the 3 big things that investors seem to be missing right now, and what that means for Nvidia stock in 2025 and beyond. Your time is valuable, so let's get right into it. First things first, I'm not here to hold you hostage, so here's everything up front. I'll quickly highlight Nvidia's awesome earnings results. I'll walk you through 3 key points that most investors are missing right now. I'll cover 3 big catalysts that could be huge for Nvidia stock in the short term, and of course, what this all means for Nvidia's shareholders as a result. There's a ton to talk about, so let's dive right into Nvidia's earnings call. Nvidia posted record revenues of $130 billion for 2024, which is their fiscal year 2025. Top-line revenues are up a whopping 114% year over year, and Nvidia posted earnings per share of $2.94, which is up 147% from a year ago after accounting for their 10-for-1 stock split last summer. Nvidia's data center segment is their biggest business unit by far, accounting for 88% of their total revenues today. Those revenues came in at $115 billion, which is up by an insane 142% year over year. Just for reference, Amazon Web Services revenues came in at $108 billion in 2024, and AWS powers around 1/3 of the entire internet. So Nvidia's data center revenues coming in higher than AWS's is a pretty big deal. One thing that's scaring Wall Street is that Nvidia's gross margins fell to 73% in Q4, which is a 3-point year-over-year decline. Nvidia's chief financial officer, Colette Kress, said that the lower margins are due to speeding up Blackwell manufacturing, and that Nvidia expects gross margins to be back to the mid-70s later this year. But what nobody pointed out is that Nvidia's gross margins for the last 12 months came in at 75%, which is actually up 2.3 points from last year, even after accounting for Blackwell's expedited production. That's the first thing that Wall Street is missing, which I'll get back to in a little bit. 73% gross margins means Nvidia is as profitable as most software companies. On top of that, their gaming revenues were up 9%. Professional visualization revenues were up 21%, and automotive revenues were up 55%, all year over year. I'm not spending too much time on these segments because they account for just 11% of Nvidia's revenues combined. But at this rate, Nvidia's total revenues could hit around $190 billion for calendar year 2025, which would mean more revenues than Tesla, AMD, and Palantir put together. That's pretty crazy, right? If you've been watching this channel for a while, you know that the key to finding great stocks is understanding a company's products, not just their profits. The best investments are usually in companies with platforms that other businesses pay to build on top of. And Nvidia is worth around $3 trillion because every major tech company relies on their accelerated computing platforms. Nvidia currently holds around a 90% share of the data center GPU market, and that's before Blackwell is fully ramped, which we know that Nvidia is speeding up even if it means lower margins in the short term. That's because Nvidia's hardware and software platforms are the picks and shovels of this entire AI gold rush, and how big it gets ultimately depends on how fast Nvidia can deploy their solutions around the world, and they want to go as fast as possible because, according to Market US, the global artificial intelligence market is expected to more than 8x in size over the next 8 years, which is a compound annual growth rate of 30% through 2033. But many of the companies building next-generation AI applications are not publicly traded. Think about the 90s and early 2000s. Companies like Amazon and Google went public very early in their growth cycle. But today, they're waiting an average of 10 years or longer to go public. That means investors like us can miss out on most of the returns from the next Amazon, the next Google, the next Nvidia. That's where the Fundrise Innovation Fund, who's making this video possible, can help you. They give you access to invest in some of the best tech companies before they go public. Venture capital is usually only for the ultra-wealthy, but Fundrise's Innovation Fund gives everyday investors access to some of the top private pre-IPO companies on Earth, with an access point starting at $10. They have an impressive track record, already investing over $110 million into some of the largest, most in-demand AI and data infrastructure companies. So if you want access to some of the best late-stage companies before they IPO, check out the Fundrise Innovation Fund with my link below today. Alright, so Nvidia's annual revenues and earnings per share both grew by triple digits year over year. On top of that, they're investing in Blackwell, ramping even faster to maintain their massive market share. That's why margins are down quarter over quarter, even though they're still up for the entire fiscal year. This is the first thing that Wall Street seems to be missing. As a result, Nvidia is trading at a price-to-earnings ratio of 42, which is close to its 5-year low. In fact, the last time it traded at PE ratios this low, Nvidia stock was just $11 per share. The second thing that most investors missed was actually a pretty big bombshell that Nvidia's CEO Jensen Huang dropped during the Q&A portion of the earnings call. Let's walk through the question and then Jensen's answer together. Timothy Arcuri from UBS asked Jensen to speak about how some of Nvidia's biggest customers are balancing ASICs and GPUs. For context, Amazon, Microsoft, and Google all have their own application-specific integrated circuits, or ASICs, which some investors are worrying compete directly with Nvidia's GPUs. And now we're seeing some superclusters use both kinds of chips together instead of relying only on Nvidia's GPUs. Jensen gave a pretty thorough answer, so I'm going to paraphrase a bit, but I'll show you his exact words on screen as I go. Nvidia built very different things than ASICs, even though sometimes they overlap. Nvidia's architecture is general, which means it's great for diffusion-based models, or vision-based models, or multimodal models, or text, instead of needing to specialize in any one of those. And Nvidia's ecosystem is so big and feature-rich that most innovations and algorithms come out on CUDA first. Nvidia is also really good end-to-end, from data processing and curating training data to the training, post-training, and inference steps themselves. And unlike ASICs that are in one cloud, AWS, Azure, or Google, Nvidia is in every cloud and can also be on premises or in a robot. And Nvidia's upgrade cycle is every year, which tends to be faster than the ASICs get upgraded. And this includes multiple chips, GPUs, CPUs, and networking chips to connect them at scale. As a result, Nvidia's total performance per watt is anywhere from 2x to 4x or even 8x these ASICs. That translates directly to revenues, since AI applications charge based on the amount of tokens generated, and most data centers either have a fixed amount of space or a fixed amount of power. Being able to generate 8x more tokens in the same amount of space and power budget translates directly to 8x returns on investment for these data centers. And I don't think that Wall Street realizes that Amazon, Microsoft, and Google's custom chips don't compete with Nvidia at all. They're slower to upgrade, much more limited in the workloads they can support, and have 2 to 8 times lower performance per watt than Nvidia's chips, depending on what innovations their massive install base have come up with and where Nvidia's chips are in their annual upgrade cycle. Let me give you a clear example. Nvidia released an open source software package called TensorRT LLM, which literally doubled the inference performance for large language models running on Nvidia's GPUs. That means the hundreds of thousands of H100s bought by companies like Amazon, Google, Microsoft, Meta, OpenAI, and xAI got twice as good at running large language models overnight. But TensorRT LLM also works on Nvidia's Lovelace GPUs, their Ampere A100s, which predate the H100s, and Blackwell GPUs as well. And this leads nicely into the third thing that Wall Street seems to be missing, which is pretty ironic considering Jensen said it on CNBC for the entire world to hear.
So now basically it's AIs teaching AIs how to be better AIs. That post-training process is where an enormous amount of innovation is happening right now. A lot of it happened with these reasoning models. And that computation load could be 100 times more than pre-training. And then here comes inference, the reasoning process. Instead of just spewing out an answer, when prompted, it reasons about it. It thinks about how best to answer that question, breaks it down step by step, might even reflect upon it, come up with several versions, pick the best one, and then presents it to you. So the amount of computation that we have to do, even at inference time now, is 100 times more than what we used to do when ChatGPT first came out.
So, AI inference takes 100 times more computation now than it did when ChatGPT was released a little over 2 years ago, thanks to all the new reasoning approaches in OpenAI's GPT-4, xAI's Grok 3, and DeepSeek's R1 models. That works out to be roughly a 10x in inference compute costs every single year, which is huge for Nvidia, and I expect this trend to continue. Let me explain why. Until recently, inference didn't need much compute because answers were generated in a single shot. The user prompts the model, and the model responds with whatever tokens it predicts come next. So inference costs were basically a function of how many prompts an AI model received and the average difficulty of those prompts. But today, we have techniques like step-by-step verification, chain of thought reasoning, and mixture of experts models, all of which generate a lot more tokens on their way to solving a problem. As a result, AI models have a whole new way to scale their performance, spending more tokens to think about a problem in exchange for a better final output. For a human, that would be like getting more time, more money, and more access to the right tools and experts to do a job. But for AI models, that means more GPU hours and better algorithms. So now, there are 3 ways to scale AI models. The first scaling law is called pre-training scaling, where the foundational AI model improves with more training data and more parameters, both of which increase the amount of compute power needed. The second AI scaling law is called post-training scaling. That's reinforcement learning on more specialized data and prompts, refining the outputs with different kinds of feedback, having the AI model practice millions of times using synthetic data, and so on. Think of this as the fine-tuning step where the model can learn over time, which also requires a significant amount of compute power. And now there's a third AI scaling law called test time scaling. That's where models produce better outputs by spending more time, energy, and tokens on the inference step itself. Should GPT-4 provide the answer in one shot, or do some retrieval augmented generation first? Should Grok 3 break its chain of thought down into 3 steps, or 5, or 10? Which expert models should DeepSeek R1 consult with, or should it take a majority vote from all of them? This is a huge area of research that's going to result in many different algorithms to solve all kinds of different problems in a wide variety of markets. But what they all have in common is benefiting from more compute, since letting models generate more and more tokens on the way to solving a problem will lead to better and better outputs. As long as that's true, AI research and development teams will keep finding new ways to generate better answers at the cost of more tokens. And now we've come full circle, because this is exactly why hyperscalers, supercomputers, and other companies with big data centers will keep buying Nvidia's chips, which are anywhere from 2 to 8 times more power efficient than the specialized chips meant for specific workloads on specific clouds. And that's why Nvidia is pushing the pace of Blackwell's production and deployments, even at the cost of their margins over the short term. More chips leads to more innovations, which leads to more AI adoption, which leads to more chips. And Nvidia understands this feedback loop better than anyone else. And now that I've covered Nvidia's earnings and the 3 key points that Wall Street has been overlooking, let me highlight the 3 catalysts that I think will be huge for Nvidia stock. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to make more deep dives like this. Thanks, and with that out of the way, let's talk about Nvidia stock. There are 3 big catalysts in the very near future. First, Nvidia GTC is right around the corner, which is Nvidia's massive developer conference. I'll actually be there live to cover Jensen's keynote, check out Nvidia's newest products and prototypes, and attend as many sessions as I can on things like robotics, self-driving cars, and even quantum computing. I'll leave a link to the sessions I plan on attending in the description below because they're online, absolutely free, and a great way to learn more about the science behind this stock. But the first catalyst is Jensen's GTC keynote, where I expect him to talk about the B300 Blackwell Ultra GPUs, which is set to ship in the second half of 2025. Remember, Blackwell is an accelerated computing platform, which means he should be talking about all the upgrades to the GPUs, but also the Grace CPUs, the Bluefield DPUs, NVLink switch chips, InfiniBand, and Spectrum-X networking solutions. And it's not just about data centers. I want to understand how Blackwell performs at the edge by touring the entire exhibition floor at GTC and seeing Blackwell chips in everything from robots and self-driving cars to desktop PCs and even Project Digits. And of course, I'll be interviewing as many Nvidia executives as I can and sharing everything I learn with you. The second catalyst is Computex 2025, which happens in May. At last year's Computex, Jensen revealed the architecture after Blackwell, called Rubin, which is slated for 2026. And just like Blackwell, Rubin is a platform, so we should expect to hear about all 6 next-generation chips involved, not just the GPUs themselves. The third and final catalyst is the architecture after Rubin. In an article published just yesterday, Tom's Hardware confirmed that post-Rubin GPUs are already in the works, and Jensen said that he'll announce them at GTC. The thing is, it's not just about these next 3 chips. It's about the overall performance gains from chip to chip to chip and the trend in performance that we can expect over the long term. The bigger the boost each one of these chips provides data center throughput, the further Nvidia extends its lead over every other AI chipmaker. And the faster AI costs come down, which means more AI adoption across the board, both of which would obviously be great for Nvidia stock. So between Nvidia's awesome earnings call, the 3 big things most Wall Street analysts are missing, the upcoming catalysts at GTC at Computex, and Nvidia's stock's PE ratio being near a 5-year low, my plan is to keep dollar cost averaging in for the long term, which means buying more shares as the price goes lower while keeping a healthy amount of cash on the side. And if you want to see what other stocks I'm buying before Nvidia GTC, make sure to check out this video next. Thanks for watching to the end, even though I gave you everything up front. And until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.